State Bank of India, SBI, has classified the loan account of Reliance Communications, a bankrupt telecom company, led by Anil Ambani, as fraudulent due to alleged fund diversion related to loans dating back to 2016. This decision, disclosed in a securities filing, comes amid ongoing insolvency proceedings for Reliance Communications, which had accumulated a debt of 404 billion rupees $4.71 billion as of March 2025. The classification of the account as fraudulent allows SBI to report Anil Ambani to the Reserve Bank of India and potentially initiate criminal investigations. This move follows a similar action by Canara Bank in 2024, which was temporarily halted by the Bombay High Court. The designation of the account as fraudulent has significant implications. Under Indian law, such a classification leads to a referral to enforcement agencies for criminal investigation and prohibits the borrower from obtaining further bank loans for 5 years. This development may impact Reliance Communications' restructuring efforts and the broader telecom sector's perception, given the high-profile nature of the Ambani family. While Reliance Communications argues that its insolvency proceedings protect it from external legal actions, the company's legal strategy and future financing options could face challenges, affecting its ability to navigate its financial recovery.
The latest ADP National Employment Report for June revealed an unexpected decline of 33,000 jobs in the U.S. private sector, contrary to economists' expectations of a 100,000 increase. This marks the first contraction since March 2023 and has significantly impacted financial markets, with S&P 500 and NASDAQ 100 futures both dipping in response. The job losses were primarily concentrated in the service sector, with professional and business services losing 56,000 roles and education and health services shedding 52,000. In contrast, goods-producing sectors such as manufacturing and mining added 32,000 jobs, partially offsetting the overall decline. Regionally, the Midwest and West experienced significant job losses, while the South saw a net gain of 13,000 positions. Larger companies added 30,000 jobs, whereas small firms with fewer than 20 employees cut 29,000 positions, highlighting the difficulties smaller businesses face. Despite the job losses, wage growth remained steady, with annual pay rising by 4.4% year-over-year and pay growth for job changers decelerating to 6.8%. The report has heightened anticipation for the upcoming Bureau of Labor Statistics (BLS) non-farm payrolls report, which is expected to show an addition of 110,000 jobs. Market analysts have offered varied perspectives on the implications of the ADP report, with some seeing it as a precursor to potential volatility in the BLS release. Concerns have also been raised about broader economic pressures, such as the impact of tariffs on importers. As investors await further data, the ADP report has injected caution into market sentiment, underscoring the complex interplay between employment data and economic policy.
Addentax Group Corp has announced a significant move to acquire up to 12,000 bitcoins, valued at approximately $1.3 billion, based on current market prices. This acquisition, which marks an increase from the initially discussed 8,000 bitcoins, is outlined in a non-binding term sheet with a major independent Bitcoin holder. The transaction, if finalized, will be completed through the issuance of new shares of Addentax's common stock. This strategic decision is part of Addentax's broader plan to leverage Bitcoin's current bullish market trend and its global liquidity. This development underscores Addentax's commitment to expanding its Bitcoin investment strategy as part of its long-term financial goals. The company, primarily known for its operations in garment manufacturing, logistics services, and property management, is diversifying its portfolio by capitalizing on the cryptocurrency's potential. However, the proposed acquisition is contingent upon the successful negotiation of a definitive agreement, due diligence, and customary approvals, with the final terms of the acquisition still to be determined. This move is indicative of a growing trend among companies seeking to integrate cryptocurrency holdings into their asset management strategies, potentially impacting market sentiment and the company's financial outlook.
The recent legislative package spearheaded by former President Donald Trump, which includes substantial tax deductions on auto loans, tips, overtime pay, and benefits for older Americans, has been passed by Senate Republicans. This package, dubbed the One Big Beautiful Bill Act, promises over $4 trillion in net tax cuts. However, experts suggest that these deductions might not provide significant financial advantages for lower-income earners. The reason lies in the structure of tax deductions, which reduce taxable income and thus offer more substantial benefits to those in higher tax brackets. For instance, a deduction of $1 is worth more to a taxpayer in the 22% bracket than one in the 10% bracket. Additionally, many low-income earners already benefit from the standard deduction, which reduces their taxable income considerably, leaving little room for additional deductions to make a substantial impact. The bill's deductions are classified as above the line, which allows taxpayers to claim them even if they do not itemize deductions. Despite this, the practical limitations of these deductions may restrict their utility. For example, to fully benefit from the $10,000 car loan interest deduction, a household would need a car loan exceeding $112,000, a scenario applicable to only about 1% of new auto loans. Moreover, income limits cap the benefits for higher earners, with deductions phasing out beyond certain thresholds. As the bill moves to the House, where its future remains uncertain, its potential impact on economic inequality and consumer finances remains a critical point of discussion among policymakers and economists.
Tesla reported a 13.5% decline in quarterly vehicle deliveries, marking the second consecutive period of decline and falling short of analysts' expectations of approximately 394,000 vehicles, with actual deliveries totaling 384,122. Despite this, Tesla's stock rose by 4.5% to 7% due to a modest recovery in demand in China, particularly for the refreshed Model Y, as well as production numbers exceeding forecasts at 410,244 vehicles. The Model 3 and Model Y continued to be Tesla's strongest performers, while deliveries of the Model S, X, and Cybertruck lagged behind expectations. Several factors contributed to the decline in deliveries, including CEO Elon Musk's controversial political positions, an aging vehicle lineup, and potential changes in EV incentives under the Trump administration's tax bill, which could phase out the $7,500 credit on new sales and leases. In response to these challenges, Musk has taken direct control of sales operations in the U.S. and Europe, following the departure of key executive Omid Afshar, emphasizing the company's focus on addressing declining sales in these regions. European and U.S. sales have notably struggled, with significant drops in registrations. Despite these hurdles, analysts maintain cautious optimism, noting that the slowing rate of decline in deliveries suggests potential stabilization or growth in the latter half of the year. Tesla's future strategy includes introducing a more affordable vehicle model, anticipated to be a pared-down Model Y, though production has faced delays. The company's performance in China remains crucial as it navigates fierce competition from local manufacturers like BYD. Sales improvements in markets such as Norway and Spain indicate that Tesla's refreshed models are gaining traction despite geopolitical and market pressures.
In today's market session, the Dow Jones Industrial Average experienced a decline, while the S&P 500 and Nasdaq Composite posted gains, highlighting a divergence in market sentiment. Tesla Inc., TSLA, was a standout performer, with its shares rising by 2.8% to $309.18, following its announcement that second-quarter deliveries met Wall Street expectations. This performance underscores Tesla's resilience in maintaining its growth trajectory amidst a competitive electric vehicle market. The mixed performance of major indices reflects ongoing investor uncertainty amid economic data releases and corporate earnings reports. While the tech-heavy Nasdaq benefited from gains in technology stocks, the Dow's decline suggests caution among investors, possibly due to concerns over interest rate hikes or global economic conditions. Tesla's positive delivery report not only boosted its stock, but also contributed to the positive sentiment in the tech sector, indicating investor confidence in the company's strategic execution and future prospects.
Del Monte Foods, renowned for its canned food products, has filed for Chapter 11 bankruptcy in a New Jersey court, marking a significant development in the food industry. The company, which has been a staple in households since its founding in 1886, plans to pursue a court-supervised sale of some or all of its assets as part of its financial restructuring. This move is aimed at facilitating a strategic turnaround to establish a more robust and sustainable business model, according to CEO Greg Longstreet. Despite the bankruptcy proceedings, Del Monte has secured $912.5 million in financing to maintain its operations, ensuring continuity for its brands, including Kitchen Basics and S&W Fine Foods. The bankruptcy filing comes after Del Monte was acquired by an investor group led by Kohlberg Kravis Roberts in 2011 for approximately $5.3 billion. This private ownership has not shielded the company from financial challenges, leading to its current predicament. The impact of the bankruptcy filing on the broader food market remains to be seen, but it underscores the pressures faced by traditional food manufacturers amidst changing consumer preferences and economic uncertainties. The court-supervised sale could potentially reshape the company's future, affecting its market position and the competitive landscape of the food industry.
Shell announced it will amend its U.S. and U.K. financial filings following a breach by its auditor, Ernst & Young, EY, who violated mandatory rotation rules designed to maintain auditor independence. Despite the breach, Shell's stock rose nearly 1% in pre-market trading, although retail sentiment on platforms like StockTwits shifted from bullish to neutral. EY's audit opinion for the affected years is now unreliable under U.S. law, prompting Shell to adjust its SEC filings. EY has since replaced the audit partner and issued updated opinions, which remain unqualified, suggesting no significant issues with Shell's reported figures. The UK's Financial Reporting Council, FRC, is reviewing the situation and may initiate a formal investigation. The breach comes after EY was fined £325,000, $445,000 by the FRC for a similar rotation rule violation. Despite the incident, Shell has not indicated plans to drop EY, although shareholders will decide on the firm's reappointment at the next annual meeting. Meanwhile, Piper Sandler has raised its price target for Shell to $83, maintaining an overweight rating. Analyst Ryan Todd cited higher crude oil prices as a key factor in raising Shell's Q2 earnings per share and EBITDA projections by 14% and 10% respectively. Shell is set to report its Q2 earnings on July 31st. The stock has gained over 13% this year, although it has decreased by more than 2% over the past 12 months.
Stellantis NV, Saintla, has been downgraded by Wolfe Research to underperform from peer perform, with a revised price target of €6, citing significant risks to the automaker's earnings for 2025 and 2026. This downgrade is primarily attributed to the company's declining performance in North America, where Wolfe's earnings forecasts are notably below consensus estimates, 40% lower for 2025 and 45% for 2026. The firm projects a €1 billion loss in the region this year, starkly contrasting the consensus expectation of a €1.6 billion profit. This pessimistic outlook follows Stellantis' report of a 10% drop in U.S. sales for Q2, impacted by declining sales in brands like Alfa Romeo, Chrysler, and Dodge, despite gains in Ram, Jeep, and Fiat. In contrast, competitors General Motors and Ford reported robust U.S. sales growth for the same period, with Ford's sales up 14% and GM's up 7%. Stellantis has faced challenges in North America, reporting a 25% decrease in shipments, a 27% drop in net revenue, and an 80% decline in adjusted operating income for the full year 2024. The company's new CEO, Antonio Filosa, who recently assumed leadership, aims to address these struggles while maintaining his role overseeing North American operations. Despite the downgrade and financial hurdles, retail sentiment on StockTwits has shifted from bullish to extremely bullish, even as Stellantis stock has fallen about 22% year-to-date and 48% over the past year.
SEALSQ Corp, a company listed on NASDAQ as LAES and based in Geneva, Switzerland, has announced significant advancements in post-quantum cryptography, PQC, to address the vulnerabilities of Bitcoin and blockchain networks against the emerging threats of quantum computing. Through its Quasars project, SEALSQ is developing hybrid cryptographic solutions and quantum-resistant hardware to protect critical infrastructures from potential quantum-powered cyber threats. This initiative is particularly urgent as quantum computing nears the capability to compromise elliptic curve cryptography, ECC, a core security component of Bitcoin and Ethereum, with over 4 million BTC potentially at risk due to exposed public keys. The urgency of these developments is underscored by BlackRock's recognition of quantum computing as a material threat in its Bitcoin ETF filings. SEALSQ's PQC-enabled microcontrollers and secure elements provide immediate hardware upgrades that integrate classical and quantum-resistant algorithms, ensuring the security of blockchain ledgers and wallet infrastructures without significant network downtime. CEO Carlos Moreira emphasized the company's dedication to establishing a quantum-secure digital economy, noting that the threats posed by quantum computing are already present. SEALSQ's technology aims to future-proof blockchain ecosystems while maintaining decentralization, privacy, and individual sovereignty. These innovations are crucial for securing critical systems across various industries, including healthcare and automotive, against advanced cyber threats. By embedding post-quantum cryptography into its semiconductor solutions, SEALSQ is positioned as a leader in the transition to a quantum-secure future.